Welcome to Insider Events Financing Net Zero, presented by IDA Ireland. Here's our host, Insider Finance Features Editor, Amanda Cantrell.
Hi, I'm Amanda Cantrell, Finance Features Editor at Insider, and I'm very pleased to be your host today. Thank you so much for being here with us, and thank you to IDA Ireland for presenting this event. The green finance movement is a fast-growing area with potentially significant global impact. The green investing conversation today generally revolves around both funding sustainability and the path to double profit, that is, profits for investors and positive social impact for society. We're going to talk about both of those things today, but we're also going to talk about the latest sustainable finance tools that investors can use to help drive the push to net zero. We feel that this is such an important conversation to have right now that we'd love for you to share it on social media by using the hashtag #FinancingNetZero. And if you look at the dashboard at the bottom of the page, you'll see other additional resources as well, in addition to speaker profiles. We also encourage you to share questions there, as our moderators will try to address those questions in our panels. And finally, we want to know what you enjoyed about today's event and what we could be doing better. So please take the attendee survey, which you can do just by clicking on the survey icon at the bottom of the page. And now I'm pleased to introduce our first session. Insider Finance reporter Reed Alexander is moderating a conversation around the global outlook for sustainable finance. Over to you, Reed.
Amanda, thanks very much. Welcome, everyone. I'm Reed Alexander, a reporter on the finance team, and we're really delighted to have you for our first session in this event to tackle an important conversation around the global outlook for sustainable finance. You know, financial firms today are coming to the conclusion that doing the right thing when it comes to ESG, particularly sustainability, isn't just the right thing to do ethically or altruistically, but it has a meaningful impact on their bottom line. And from a fiscal perspective, it's a smart play. A growing body of evidence is supporting that conclusion if you just look at the data. For instance, new data that takes a look back at progress from the first quarter of this year from the data provider Refinitiv found that there were 220 plus sustainable M&A deals that took place in the quarter. That's a significant upswing from what we had seen year over year, and that amounts to more than 58 billion in consolidation activity. And then if you talk about sustainable bond issuance on the debt side, we saw more than $286 billion in issuance in the quarter. That's an all-time high. So over the next 20 minutes, we want to really unpack what the wins at the back of sustainability mean for the global financial services industry, both in terms of capital market advisory and on the buy side among investors. So we brought together a really phenomenal group of 3 experts in this space, and we're happy to welcome Melissa James. She's the Vice Chairman of Global Capital Markets at Morgan Stanley and co-head of Morgan Stanley's ESG Center for Excellence. We've got Sandeep Sen. He's the co-head of the Natural Resources and Clean Energy Transition Group within the Banking, Capital Markets, and Advisory Division at Citigroup. And Megan Starr is the Global Head of Impact Investing at the Carlyle Group. All 3 of them join me now. It's really a pleasure to see you. We've got a lot of ground to cover over the next 25 minutes, so I want to go right ahead and point our first question to you, Melissa James of Morgan Stanley. So help us understand how ESG, particularly with an eye toward the E, environmental issues, sustainability, is really evolving in the capital markets, and what kind of implications does that have for capital markets decision-making, Melissa?
Well, Reed, 2020 was an inflection point for ESG. And as a result, it's really now a mainstream topic. And one way in which that's manifesting itself in the global capital markets is with the explosion of issuance in the ESG labeled bond market. So you mentioned the $286 billion of issuance in the quarter. Last year, there was over $500 billion of issuance in aggregate in the ESG labeled bond market. And that was up over 80% year over year, 2019 to 2020. The growth in the issuance was really fueled by the fact that companies now recognize that investors are willing to reward them for incorporating sustainability features into their debt issuances in the form of a lower interest rate. And so that's why we've seen so much issuance activity. You couple that with the fact that we've also seen diversification in the type of issuance on a variety of fronts. So, for example, in addition to there being issuance that is specifically for environmental purposes, there is also now more social issuance where the use of proceeds is for social concerns, as well as sustainable issuance where the use of proceeds is for both social and environmental good. And so that's another way in which the market has evolved. A second form of diversification that we've witnessed is the advent of the sustainability linked bond, where now you're seeing not just use of proceeds issuance, where the use of proceeds is targeted to specific environmental and social projects, but you're also seeing issuance activity where the interest rate is linked to certain sustainable key performance indicators that are either social or environmental. So this really opens the path for a much broader array of companies to issue ESG labeled debt in this format, because there are a lot more companies that can establish these targets and reach these goals over time than there are companies that can necessarily define a specific use of proceeds today for these activities. So there's just been tremendous growth and tremendous diversification.
Yeah, really interesting, the intersection of E and S there. You mentioned social issues as well tied to these sustainable bonds. Really fascinating stuff sort of around the tools and the toolkit that are available. And speaking of which, there has been an advent of demand for all of this, and some firms are even responding to it by setting up designated units of their own. So I want to bring in Sandeep Sen from Citigroup now. Citigroup has done something really interesting, Sandeep, as you well know, in the past few weeks. Citigroup has set up an NRCET, Natural Resources and Clean Energy Transition Group, within its investment banking division, the BCMA division. Now, you co-head that division. So why don't you tell us what the impetus was to set that group up and some of the services that the group is tackling?
Yeah, thanks, Reed, and thanks for having me on this panel today. So yes, this group was formed about a month ago, a little bit over a month. It represents a reorganization combining the energy group, the power group, and the chemicals group. But it's called Natural Resources and Clean Energy Transition. And the impetus of forming that group was a recognition of the fact that all three of those industries, amongst other industries, are experiencing a rate of change that is frankly unprecedented. And each of those industries are interconnected in some way or the other. Energy and power, more so I would say than chemicals, but even in chemicals and energy, biochemicals, et cetera, they're all connected. So the thought behind setting up this group is to formalize and put discipline around the coverage and the nurturing of what we believe will be a new subsector of clean energy transition companies. They will all be connected to the legacy sectors, if I can call it that. But what it entails is the emergence of new companies, existing companies being restructured, and this can come about via IPO, via spinoff, via asset sales, all of the above. And we want to be at the forefront of helping our clients, old and new, and we want to do it with the kind of focus that we generally provide to bigger companies. I mean, the truth is a lot of the new companies we expect are going to be smaller, but we do see a ton of restructuring of existing industries, new companies that will require products and services that are otherwise provided to bigger companies. And just as of last night, or I should say this morning, under the NRCET group, we have formed what we are going to call Clean Energy Transition Sector. So we will dedicate bankers, which we have identified, and they'll be pulled out of the existing groups, not because they weren't doing a good job there, but they've been identified as folks that some of them have already been focused in these areas, but it will be under this new group that will be dedicated. We will put rails sort of so that there's discipline and accountability and most of all, focus. And the goal is really to expand the pie for ourselves in a selfish way, but more so and equally important, helping existing clients and new ones that get born out of this absolutely global super mega trend that is energy transition. So we're super excited, and we see a lot of opportunity for us and for our clients.
That is exciting indeed. I mean, I think if there was ever a case study in the importance of responding to these issues, the fact that you've set up a designated team, and I personally am so fascinated as a reporter who covers banks in this idea of collaboration that perhaps we can touch on at some point in our discussion between bankers, since pretty much I think every client these days has at least an eye towards sustainability in some way, shape, or form. But I want to now switch sides to the buy side. I want to have a look at what investors are thinking. I want to bring in Meg Starr. She's with us from the Carlyle Group, the Washington, D.C. based private equity firm, where, Meg, you are the head of impact investing. And what I find so interesting about your particular role, I think when we think about impact investing or sustainability investing in a lot of companies, it's off to the side, it's complementary. There may be special initiatives, but they're not really baked into the entire comprehensive global investing strategy. Now, as I understand it, and I'm hoping you can paint a picture for us, you're working hand in hand with sector heads to make sure that impact strategies, ESG strategies, are folded into all of their calculus around deal making. So why don't you explain to us your role in collaboration with sector heads and how and why Carlyle sees this sustainability focused investing imperative as so core to the acquisitions and investments that you're making there?
Thanks, Reed. We've taken a little bit of a different approach in this space because I think sometimes impact has this concept of an artificial binary between good companies and bad companies, and that isn't the reality that we live in. And so we very much view impact as change over time, and actually think that private investing is particularly well suited to that because we have the tools of longer time horizons, the ability to invest capital, a really significant focus on business transformation. And so at Carlyle, we think of impact as building better businesses because frankly, in this day and age, they're worth more. So a couple of quick examples building off of what Melissa was talking about. We've seen a lot of really interesting movement in the financing markets. We just bought a company earlier this year called Flender. It's a carve out from Siemens in Germany. Flender is an expert in mechanical drive technology, core manufacturing company, but they have a very significant and growing business in wind gearbox turbines. And so one of the things we did was we did €1 billion of financing when we acquired that company. And the cost of that debt was linked to the number of wind gearboxes that Flender can produce. And so if they're able to exceed targets, they get 10 basis points off their debt, and vice versa if they miss those targets. And so again, back to this idea of using the tools of private equity to think of impact as change over time. How do we help manufacturing companies diversify and really build business models for the new energy ecosystem? We've also applied that financing to our lines of credit. We just did a $4.1 billion line of credit for our America's corporate private equity, and the cost of that debt is linked to our Carlyle corporate commitment to having at least 30% diverse directors on our majority-owned boards within 2 years of ownership. We have clear financial evidence that that leads to better outcomes. Our companies that have at least 2 diverse board directors have about 12% faster annualized earnings growth than our companies without diverse directors. And this was another example of a unique spin in finance of saying, how do we link those targets to better financial outcomes so we can further this convergence of environmental and social progress alongside of financial profitability?
Meg, thank you. I just want to bring back in Melissa on this point because we're talking about this question of bonds and sustainability and some of these targets that make issuing debt potentially more affordable if you do the right thing and you can prove that you've done the right thing. Can you help me, Melissa, to understand how exactly that works, sort of describe those levers for us? And also, to me, it makes me think that companies must be really doing a deep dive now on how they can gather data to prove that they're meeting their targets that they set out at the beginning of the debt raising process. Could you just walk me through that, Melissa, how that works?
Certainly. So in the case of transactions that are sustainability linked, where the coupon or the interest rate is linked to the performance of a particular key performance indicator, companies will specify up front what those indicators are. They can be either environmental or social or both. In the case of a sustainability linked issuance, they are both. So you'd have a target, as an example, of reducing your carbon emissions by a certain amount by a certain date. And you might then also marry that with a provision whereby you specify a certain percentage of diverse board members or senior management members that you're likely to have by a certain date. And effectively, you have to monitor yourself relative to those goals. And if you have not met those goals at that date in question, then there is typically a coupon ratchet that occurs as a result of that. In the investment grade corporate bond market, that coupon ratchet is typically about 25 basis points. In other markets, in the high yield market, as an example, there's been more variability in what that coupon ratchet actually is. But typically, that is the mechanism or the manner in which these transactions are structured. And effectively, it's really allowing companies to get rewarded for doing the right thing, as you said. So what investors will do is they will actually offer those, lend that money initially day one at a lower rate of interest than they might otherwise. So there is a greenium or sustainability premium typically associated with those issuances, where borrowers are able to save, again, in the investment grade context, anywhere from 5 basis points to as much as 15 basis points, depending on the situation.
Fascinating. Thank you for helping me understand that and our viewers. And before I come back to you, Sandeep, and I will in just a moment, Meg, you touched on some of your corporate imperatives that Carlyle has announced, and you've focused a lot around diversity. I know we're primarily talking about sustainability, but a point that I want to make over the course of this discussion is how organizations can model good behavior. And we're going to talk about that on the banking side, but I do think it's really interesting on the private equity, investment, alternative asset manager side, how Carlyle Group has taken some stands around this, including most recently tying CEO compensation to diversity, equity, and inclusion-focused leadership at the firm. Could you just give me an overview of some of these ESG-related efforts, even if they focus more on the S or the G that Carlyle has put into place that you've been speaking about before?
Sure. Like Sandeep, we have some hot off the press news. And we did announce this week that we had formally included diversity, equity, and inclusion targets in our executive compensation and broad-based compensation across the firm. And I think one thing we realized is that we have this evidence that diverse teams make better decisions and lead to better financial outcomes. We need to think about that not just in our investment portfolio, but also amongst our own staff, because a lot of times in private equity, we're putting our investment deal team members onto portfolio company boards. So we've done a few different things. We have mandated diverse slates in terms of hiring decisions. We have rolled out a training on unconscious bias across our different Carlyle teams, and that's resulted in real progress. About half of our AUM is led or co-led by women, which is pretty special in this industry. And so I think when we think about ESG, there are a lot of different categories that fall under this broad bucket. We like to think of them distinctly because the concept of being good at ESG writ large, what does that mean? There are very specific dimensions of business excellence where there are clear financial correlations. So we think of things like climate resilience, engaged employees, and importantly, diverse and inclusive teams. And so we've worked really hard to figure out where there are levers to drive social and environmental outcomes, but those outcomes that converge with performance.
Thank you so much, Meg. So now I want to bring in Sandeep Sen from Citigroup, because speaking about modeling the right kind of behavior on this, banks have realized that it's not just about providing advisory services to their clients, but there's a role that the banking community can play in actually helping to, lead by example here. And clients see that and they follow it. So Citigroup, on Jane Fraser's first day as chief executive at the beginning of March, came out with a pretty bold announcement, which Morgan Stanley has done something similar as well, committing to going net zero by the year 2050. I was hoping you could explain to me what net zero emissions by 2050 actually looks like from a material sort of workflow perspective for Citi, what the goal is about, and also how you think that taking a stand like that can impact the way that your clients are thinking about this too when they see you guys coming out and making such a serious commitment.
Sure. So as you noted, our CEO made this commitment on her first day on the job. And it's a bold commitment. It will take a lot of work, but it will also take a lot of work regarding with our clients, because our measurement of net zero by 2050, because we're a bank, entails what we do with our clients, i.e. our portfolio, what that looks like, et cetera. So to the extent that our clients are not sort of complying or coming along, we are here to help them. We want to put this out, and we are in the process of working to set targets, both from a portfolio standpoint, as well as letting our clients know this is our goal. It's not so much a warning shot, but rather saying, we have set this goal for ourselves. By the way, it's actually somewhat convenient because many of our clients have also done the same. So the direction of travel is, I would say, quite uncontroversial. It's not at all. Most of the clients we deal with are headed in that direction. And conveniently, we are here to help them. And by them moving in that direction, they will be helping us. It's sort of a probably symbiotic relationship that is not completely visible to sort of an untrained eye, if I may use that phrase. And so we're helping clients think through how they allocate capital, how they are valued based on how they allocate that capital. Obviously, Melissa and Megan have mentioned how their debt costs can go down if they are, quote, doing the right thing, and the market is actually measuring them by giving them price concessions and or penalties if they didn't. So we're seeing that across the board. So when we say net zero by 2050, we're setting goals for ourselves, but derivatively also setting goals in some ways for our clients, but not just setting them and warning them, but simultaneously communicating that we are here to help, both from a capital perspective, from an advisory perspective, all of the above. And so we're I don't think it's a goal that we've set lightly. It's a tough goal. I think it's a tough goal for everybody, but everybody is, not everybody, but most of the world appears to be moving in the right direction. So hopefully we can all get there together.
Fascinating. Thank you. This data question is such a huge question that comes up in any conversation around ESG, but I have to hope that it's getting better and that we're able to move in the right direction on this. Melissa James of Morgan Stanley, at a high level, can you help me to understand what is the issue around quantifying some of these ESG targets in data form? I would think a lot of smart people are working on this, but how does that also play into some of these nuances around valuations, or I guess how does that trickle down into the boardroom? Because it's one thing to recognize we have a problem, but I'm keen to know how it shows up in the kinds of client interactions you have, the kinds of deals that you're doing.
Well, what I would say as it relates to data, Reed, is that the market is evolving, as you point out. And so as a consequence, I think we're not at a place where we have really agreed upon standardization with respect to disclosure around environmental and social issues. So that's one of the challenges, but that is coming. It's just a matter of time. What we're seeing from a valuation and an M&A perspective, I would say, is that ESG is being taken into consideration as it relates to the impact on M&A transactions. And we think that's the case because increasingly companies recognize that ESG can have an impact on valuation long term. So, for example, we've looked at the S&P 500 companies and their correlation between ESG stewardship and financial performance. And one place where we've seen a really strong correlation is between ESG stewardship and betas. So companies that generally speaking have better ESG scores tend to have lower betas. That translates into a lower cost of equity. When you have a lower cost of equity and a lower cost of debt, as we said, as a result of being a good ESG steward, that means your weighted average cost of capital is lower, and that is going to influence your capital allocation decisions. And it will, affect your hurdle rate as it relates to evaluating acquisition opportunities. So as a general matter, we're seeing companies take into consideration the ESG impact of their M&A transactions, just like they would take into consideration the impact of a transaction on other more traditional financial metrics like EPS or cash flow or credit ratings even.
Yeah, that's really interesting, Melissa. You've been talking about some of the important considerations. Oh, I'm sorry, Sandeep. Did you want to add something?
I was just going to add to what Melissa said. I spend a lot of time in the power sector, and over the last year or so, the market, just as Melissa's saying, has started to differentiate. And what we have observed is companies with high ESG scores and those that are considered, good stewards of ESG tend to trade at a higher multiple. basically repeating what Melissa is saying. Obviously, she's observed it in a broader basis, but we've actually seen that, very, very precisely in the sector that I work on, and a higher PE multiple gives you a lot more flexibility to do other things if you wanted to use that currency.
Meg Starr from Carlyle, when you're assessing a strategic acquisition, what are some qualities around sustainability that come to mind when you're eyeing a company that may not be an ESG-focused company, but has made clear in the process of diligence or management meetings that it is thinking about these issues? What are some things that you're looking for and that you want to hear from a counterparty?
Well, and to this question of data, Reed, I think ESG data is a source of huge consternation in the field, but I also think it's a huge opportunity because that's where active management can come in and differentiate itself. How do you actually use that data to drive differentiated insights in the investment process? So I'll give a couple of examples because ESG really used to just be a focus in the diligence phase. How do we identify material, predominantly downside risks, so we understand how to price them, integrate them into how we're valuing investments? That has expanded out significantly, obviously into value creation during the hold period, significantly into exit implications, but also backing up to how we're sourcing deals in the industries that we cover. So during diligence, we now use data for all sorts of things. For example, we were looking at a portfolio of assets on coastal real estate last year. And so we worked with a specialized climate risk consultant to help us model out data like sea level rise and extreme weather-related events and how that could impact insurability. For certain assets, we do carbon pricing sensitivities during diligence because we want to understand as our companies increasingly exit into carbon-constrained environments, how that could impact terminal value. During value creation, we're really focused on the material issues for a company. Not all ESG issues are created equal. Where can we really have that rocket ship growth? By taking advantage of changing consumer preferences for sustainable goods or new growth markets because of the energy transition. And then on exit, it's really honing in on what matters to that business and its future earnings potential. We just exited a business called Liberty Tire Recycling, and the ESG team at Carlyle worked hand in hand with them to help model out their impact thesis and quantify the environmental impacts of their core recycling business. That was an important part of the sale process, and they exited to an environmentally oriented equity sponsor. So we're really seeing data being used in very specific, nuanced ways. And I think because there is that lack of standardization, that presents a real opportunity for differentiation and how active managers are able to effectively integrate it into their process, as opposed to using it as a checkbox or compliance exercise, mainly for marketing.
Yeah, no, that's really interesting. You said rocket ship growth there, which makes me think of the entire growth in the whole space of ESG. Just when we looked at that data at the outset reflected the amount of M&A transactions, the amount of sustainable bond issuance. I think it's fair to say when we look back on Q2, Q3, Q4 activity from this year, we're really entering an inflection point where ESG seems to me to becoming part of the mainstream deal calculus. And I want to thank all of you. Our conversation could certainly persist, but I feel like I've learned a lot, and I hope our viewers have as well, around these tools in the toolbox for financing and the role that capital markets advisors and investors can play in moving the ball forward here. So a big thanks to Melissa James of Morgan Stanley, Sandeep Sen of Citigroup, and Meg Starr of the Carlyle Group. I'm Reed Alexander for Insider. Our special live financing net zero event continues now. Stay with us for 3 more dynamic sessions. I'll hand it back to my colleague, Amanda Cantrell in New York.
Thank you, Reed, and thank you so much to Megan, Melissa, and Sandeep for sharing these insights. For our next session, Aaron Weinman, Capital Markets Correspondent here at Insider, welcomes leaders from JP Morgan Asset Management, BNP Paribas, and IDA Ireland to discuss how the net zero transition is being financed. Over to you, Aaron.
Thank you, Amanda, and hi everyone, and thanks for joining us at Insider's Financing Net Zero virtual event. We've got a stellar trio of panelists here to discuss the tools that are funding ESG initiatives and help determine how investors are working to heighten their sustainable footprint. I've got Anne Van Riel, the co-head of Sustainable Finance Capital Markets at BNP Paribas, Jennifer Wu, the global head of Sustainable Investing at JP Morgan Asset Management, and Kieran Donoghue, IDA Ireland's Global Head of Strategy, Public Policy and International Financial Services. Thanks everyone for participating in this discussion. Sustainable financing has become a hot button issue that's grown exponentially in recent years. Climate change, social justice, and gender equality are front and center for governments, corporations, and financial institutions which are investing billions in ESG initiatives. So with all that in mind, there's a plethora of funding structures to unpack. And perhaps, Anne, if I could throw it to you first, can you perhaps dissect what's worked in the financial markets so far?
You're right, the markets have grown exponentially. I think in the first 4 months, we have already surpassed the total volumes in the sustainable bond markets for 2019. So we keep on growing this market quite rapidly. Just to get some terminology out of the way, because we throw around a lot of acronyms and different terminology. Sustainable bond markets really mean all the ESG-linked capital market debt products that there are. And in recent years, that has grown from more of the traditional green bonds, use of proceeds format, to a wider range of different types of bonds that are issued. Green bonds, social bonds, sustainability bonds, which is if there's a combination of green and social projects being funded. And in the last year, we've seen the rise of what we call the sustainability linked bond, which is yet another format where you don't have specific dedicated use of proceeds, but you have a normal bond, general corporate purposes, but a specific target linked to a company's environmental and social and governance metrics. And if you don't meet the target, there is a coupon step up or pricing increase. So those are a little bit the flavors. And we see that in the bond market, the public capital markets, but the same equally applies to the loan market, where we see similar structures as well.
Thanks, Anne. That's really helpful. I'd like to unpack some of those structures in the time we have today, but I do want to bring in Jennifer to the conversation as well. From the investor perspective, I mean, how are you sizing up these opportunities, Jennifer, when you look at your portfolio? And perhaps tell us the process of maybe scrutinizing the ESG worthiness in financing instruments.
I think, like Anne said, there is just a wide range of different types of instruments now that's available to us as investors. So I think as a start, we need to first understand what is it that we're trying to solve for, right? If what we're trying to solve for is to direct capital to a specific areas that requires green financing, then I think a very straightforward answer would be something like a green bond, right? Whereby the use of proceeds is very clearly defined. And also from a reporting standpoint, you could also really establish that link. Whereas if your purpose or intent is really to promote sustainability across the board, then I think a sustainability linked bond, i.e. there is no defined ways of how the proceeds are get used. That's probably a better way of allocating your capital, which is to really provide incentives for companies to do better from a increasing energy efficiency standpoint or gradually decarbonizing their business mix. So I think that's the starting point. That will also help to define what you do. The other point I would mention here is that there is actually very well-established guidelines in the market. For example, if you think about ICMA, International Capital Market Associations, they've published guidelines on green bonds, social bonds, and so on and so forth. So I think for an investor who's only getting into the space for the start, these are some of the good sources that you could refer to help you understand whether some of these issuance or instruments are actually in line with what you expect them to be.
So while these developments in ESG are significant, there are still large swaths of the world that rely on fossil fuels. It's not something financiers and companies can just cancel out. So what is the business world doing to address transitional efforts to low carbon alternatives?
So firstly, many of our client companies have already publicly subscribed to net zero. So that's already part of their strategies. And as part of our conversations with them, we get a detailed sense of what their sustainability strategy is going to be, the time frame over which they're going to execute that. The vast majority of the companies and of the sectors in our portfolio are not from heavy carbon emitting industries. As a general rule, they tend to be low carbon emitting investors. Those that do emit carbon are part of the European Union emission trading scheme. So the vast majority of our clients have a good plan in place to progressively reduce their carbon footprint over time.
Can you talk to us about how financiers are helping that transition, or what are some of the sort of the headwinds as well in implementing transitional policies into economies and towards companies that have been traditionally, heavy carbon emitters?
Yeah, happy to comment. And traditionally, the green bond market was really to finance those what we call dark green projects like renewable energy and green buildings that would immediately have a positive impact on the environment, or at least not a negative. What I think the market and everybody has come to realize is that there's a number of high emitting industries where there's maybe no alternative yet in terms of technology that is low carbon, or at least transitioning to where we all want to go, the alignment to the Paris Agreement goals, and then we're really talking about industries that are essential to the economy, cement, for example, or steel making, where there's just no economically viable alternative yet for producing these products. And that's where transition financing comes in, and you have transition bonds that finance projects that are not green necessarily yet, but are on a pathway to get there. The sustainable linked loan or bond is also a format that addresses that issue. It's used primarily by companies that do not necessarily have the capex or the expenditures dedicated to green projects, but their overall business strategy is to reduce their energy consumption or their emissions. So there's different ways of addressing it. I think where we need to be very cognizant is that it is a product that is, there are guidelines around it as well. There's the transition guidelines by the ICMA. It's not meant to be used by any issuer that wants to do something but doesn't want to go the whole way there. So you have to have a very strong strategy on how to get there and how to get to lower emissions. So it's a difficult product. I will say it's easier to say, okay, we'll do a green bond for a renewable energy company than to come up with an issuance around transition.
Got it. Understood. That's interesting because, and the reason, one of the other parts I wanted to ask was, at the end of the day, banks, financial institutions are still providing financing in some instances to carbon emitting industries, right? I believe that there was an article I saw this morning regarding, the fact that banks do earn a lot of credibility and fees from green-related financing, but they also earn a lot from heavy carbon emitting industries. So is there also a transition in place for the actual banks itself in the way they work with their clients?
Absolutely. I think there's a lot of plans in place, and as with anything, this doesn't happen overnight. Like the economy, banks finance the normal economy, and we also finance higher emitting industries where there's maybe no alternative. Many banks have zero new coal policies, like BNP is a very early adopter of that one. And banks have increasingly also come up with strategies and towards net zero or towards greenifying their balance sheet. So the principles for responsible banking is one such overarching community of banks, how to integrate ESG policies into the whole lending strategy. It's just not something that you can change rapidly overnight with big balance sheets at stake.
So Kieran, perhaps from a public policy perspective, what is IDA Ireland undertaking to address the funding of ESG initiatives? And secondly, how are you and your team engaging with the financiers of the world?
So thanks, Aaron, for the question. So firstly, IDA Ireland, as you know, is a public body responsible for promoting Ireland for foreign direct investment. We manage a total client portfolio of approximately 1,600 firms. So we've just published a brand new strategy, and we've put sustainability right at the center of that strategy. So what that means in practice is that we're now reaching out to our multinational clients and having conversations with them around their sustainability agendas, with a view to financially supporting them to develop corporate climate action plans for their Irish sites. Secondly, we've also established a brand new green economy division within the organization that is now actively searching for sustainability investments on a global basis.
If I may, just pivoting away from the E in ESG, I mean, I think it's important to talk about the social and governance issues that are also part of financing. And perhaps, Jennifer, I'd like to get your point of view here. So how can you, from your seat, contribute to a greater adherence to social policies, whether it's justice related, whether it is gender equality? I mean, how does that impact your investment decisions?
Yeah, I think they are. That's a good question, because I think they're all interconnected, right? At the end of the day, if we want to make sure that we're investing in companies that are helping with transition to net zero, not only we want to make sure that they have the right technologies in place, but also we want to make sure that they have the right governance structure and the right people. So talent is really very important. So in my mind, like, you can't really have a good pathway to transition if you forget about the S and G, Aaron, to your point. But broader than that, I think, if we think about this in a more holistic way, what we want at the end of the day is what we call a inclusive and sustainable economy, right? And climate is a very big part of it, but so are the other components like societal, equality, justice, etc. So as part of our investment, I think this goes back to your earlier point. How could we in the business world help to finance the transition? I think there's also another side of it, i.e. going beyond what's the use of proceeds. But when you invest either as a equity shareholder or a bondholder, you want to look at the issue or the companies itself. You want to look at the ESG credentials of the company, because that's the only way for you to ensure that however the money is going to get used will be used in the most appropriate way. So that's something that we do across our entire actively managed strategies, which is, really integrating the consideration of ESG. And so I think with that, you could really then think about, okay, do I then pivot part of the capital into areas which requires more adventurous financing or more higher risk financing, such as venture capital into carbon capture and storage for some of those sectors that are just harder to decarbonize. So I think, ESG needs to be at the foundation and integral to everything you do. And then on top of that, think about where you want to leaning a little bit more to gain exposure to specific opportunities to help with the transition.
What are these options, really simply put, beyond environmental linked financing options? I mean, what else can the financial world or financial markets do to promote social issues and governance issues as well?
If we stick with the topic of the sustainable bond markets, the inclusion of social categories in bonds has been growing in the past year, I would say. With when COVID hit, I think there was a big realization that specific minority groups or specific parts of the society were harder hit. So there's been a bigger focus by companies to provide more assistance or directed, targeted funding or assistance to these groups. And I'm not talking about charity, but more about training programs for women or minority groups. I think there's a bigger focus on making sure that the representation of women and minority groups in leadership positions becomes more equal. I think we're very far behind on that in the US particularly, but it probably is equal in other parts of the world. So there is a bigger focus on it. I think more money will be directed at initiatives like that, and the social bonds or sustainability bonds can be a way of directing that money. Interestingly, I think there was a PE firm this week that announced the inclusion of a D&I target in a sustainability-linked bond. So I think you will see more of that coming as well.
It is unfortunate that it takes human tragedy to kind of get the world to react in the way we kind of want it to be on the right side of history, which brings me to my next point. We can't talk about ESG and green-related financing without addressing the subject of greenwashing, particularly in the capital markets and the public relations perspective. I mean, Kieran, I'd be interested to get your take from a public sector perspective. I mean, a lot of the skeptics might say that green financing or ESG initiatives could be nothing more than lip service. I mean, how do we prove them wrong, if you like, or how do you prove the naysayers wrong?
Firstly, when someone mentions greenwashing to us, we acknowledge that greenwashing is a risk. There is evidence that it has happened and continues to happen, in part because every business now wants to embrace the sustainability or climate action agenda. That said, we also recognize the interventions that policymakers and regulators have taken, which we believe will diminish the prospects of greenwashing over time. So an example of this would be the European Union's Sustainable Finance Disclosure Regulation, and also the taxonomy regulation that is being introduced in Europe. The introduction of classification of investment funds, etc. We think that will diminish the risk of greenwashing over time, and that right now we're on a much better path with respect to managing greenwashing in terms of the climate agenda discussion.
I agree with Kieran. I think policy and regulations are crucial at this juncture. And if you think about it, I think there's finally better appreciation of how if the companies themselves don't provide disclosure, or the disclosure on be it climate-related data or other type of sustainability metrics are just not consistent and not standardized, it's very, very difficult for investors or financiers, if you like, to be able to judge whether this company or this issuer or this investment opportunity is really going to channel capital to where it needs to be. So I think regulations to make company disclosure on some of these sustainability related metrics is really crucial, right? Because I think standardization will help to create transparency and really level the playing field for everybody. And that's the only way that you could really help to further advance the transition, because otherwise it's going to be really hard if you don't have a transparent system in place such that retail investors, if you like, can compare one product to the other.
Excellent. And Anne, do you believe that the penalties that are, I guess, offered in these capital markets instruments, are they material enough?
I think we're at the start of the developments in this market on the sustainable linked bonds, and we'll see where it goes. But I think in the end, this is a public market instrument, and investors are increasingly very savvy on how to evaluate these and benchmark them. There will be increased scrutiny on the ambition level, on the selection of the KPIs, and what the consequences of not meeting them. So there will be a development, and whether that will be in terms of the structure that the coupon step up may be higher over time, or whether it will be because some bonds will just perform better than others, or have a larger uptake in the primary market and more interest from investors, we will see. But I think it's important to realize that a lot of this so far has come from voluntary guidelines, right? The investors and issuers have gotten to this point through voluntary guidelines, transparency, and disclosure. The EU taxonomy and increased regulation will speed that up and make this more ingrained in the financial markets. So I think that we'll see more innovation and changes to come to this with this in mind.
I know that BNP and some of your peers have completed transactions, sustainable transactions, for companies that as we mentioned earlier, may not necessarily be known as low carbon emitters. Could you talk us through how the structuring process is for a company that is a pulp and paper producer or a cement company, perhaps? How do you talk through a transition process with them compared to a green financing for a solar plant, for example?
Yeah, the discussion around those type of products is really about how do you set an ambition level on your reduction of your greenhouse gas emissions, for example, that is as much science-based aligned and as much supported by the available technology in a certain sector. And there is a lot of thought going into structuring them and making sure that we are not just throwing out a number and saying, you know, this is sufficient. We look at available technology for certain production processes. We look at what peers are doing in the sector to benchmark, you know, where they are at what level. We discuss science-based targets to make sure that we're aligned with, you know, a 1.5 degree climate assessment. So it's not that easy for an issuer to come up with an ambitious target and to commit its financing to it. So that's very important to realize, right? It's a big exercise and a big commitment from a company to issue these instruments.
I want to understand, when you have these discussions from a public sector perspective, what are the biggest headwinds or roadblocks, if you like, when you speak to your peers and your clients about enhancing ESG-related initiatives? I mean, what's the biggest sort of roadblock right now, if you had to summarize it?
I think it's been very well received. The vast majority of our clients already have quite sophisticated sustainability agendas, but they're anxious to identify opportunities to refine them and to improve them. For those clients that are a bit earlier in the sustainability journey, if I could call it that, they're really, really interested in having this conversation and understanding from best practice and from exemplars elsewhere within the portfolio, so they can learn from either their peers or from companies that are more advanced along the sustainability journey. There's also a recognition that climate risk now equals investment risk, and understandably, as professional investors, the vast majority of our clients want to take steps to protect their investments and their assets from the risk posed by global warming.
Got it. And just quickly, Jennifer, as well, I mean, when you have these discussions with potential clients or investments, what would you say is your first question to these people or to these entities when they come to the market or come to you with ESG initiatives or financing opportunities?
For me, the bottom line is there needs to be recognition that climate risk is investment risk. So it basically, for any companies that are looking for us to invest, or we engaging with companies we already invest in, it has to be part and parcel with everything that they do, be it from CapEx planning or just, you know, managing their business on a daily basis, because there's real costs associated with not planning ahead for transition or other potential physical climate related risks. So I think for me, that is like first and foremost, top of mind for almost all of our clients. And also, front and center in all of the conversations that we have with the companies that we invest in.
And Jennifer and Kieran, thank you all for highlighting some crucial points regarding sustainable finance. As you all alluded to, there's a ton of ways that financial markets can best serve ESG requirements, and there's evidently plenty of work to be done to heighten the industry, the transparency, accountability for corporations, governments, and financial institutions. So thank you again for joining us today, and I'll take it back to you, Amanda, to introduce our next panel. Thanks.
Thank you, Jennifer, Ann, and Kieran, for this important conversation. I want to take this moment to remind our audience of the official event hashtag, #FinancingNetZero. Please help us spread the word around these conversations about financing the net zero transition. And feel free to take our attendee survey at any time during the event. Just click on the survey icon at the bottom of the page. And now, another interesting session where our guests will talk about the path to double profit. I'm joined here in the studio with Insider's Finance Features correspondent, Danielle Walker. Over to you.
Thank you so much, Amanda. Welcome, everyone, and thank you for joining us. In the past year, many investors have wanted to make an impact with their capital on issues from racial inequity to climate change. Still, many need guidance. I'll be asking our panelists about new impact investing opportunities and ways the public and private sector can partner. We'll also discuss how data and corporate disclosures can push impact investing forward. I am joined by Warren Valdmanis, a partner at 2 Sigma Impact. Thank you for joining us.
Danielle?
Warren, can you expound a bit on the work 2 Sigma Impact does and its focus?
Absolutely. So 2 Sigma Impact is a private equity business focused on workforce issues. And so what does that mean? First, it's because it's a private equity business, that means we buy companies. We usually are in a position to control those companies, and we're usually involved with those companies for many years, often as long as 5 or 6 years. And so we have both the opportunity and the responsibility, frankly, to think long-term in our governance roles with these companies. The second thing about 2 Sigma Impact is that we're focused on workforce issues. So the business is predicated on the idea that good jobs is good business, and investing in people is actually a great way to drive long-term value at companies. And I think that the observation that I would make is that many American companies have forgotten how to be great employers to their detriment. And we think there's a big opportunity, especially within private equity-owned companies, to drive long-term value by investing in people. And the third thing is, because our parent is 2 Sigma, we are a data-driven business. 2 Sigma is a financial sciences company that employs about 1,000 data scientists and has a large reservoir of data. And so we have the ideal parent for helping to bring the impact investment world from the artisanal place where it began to a more scientific place where we understand better how to measure social output and how to connect it to long-term value creation, which I think is a critical link to establish if we hope to bring this field forward.
Thank you so much. And you made a great point about companies forgetting to be good companies. Can you tell me a bit about how the pandemic and the past year has impacted the work that you guys do? And more generally, how has it shaped the private equity space?
Yeah, so the pandemic has, I think one of the silver linings of the pandemic is that it has helped the investment world to focus on the S in ESG. So I think that it's long been understood that good governance is important to corporations. And then I think it's increasingly being understood that strong environmental practices are critical for corporations. But S has been the forgotten letter of ESG for a long time because social issues are tricky to measure. Things like good jobs are tricky to measure. But I think that the pandemic has shed light on how important these issues are, and how I think just the image of seeing frontline workers out there being exposed during the pandemic, I think has focused a lot of attention on how important workers of all levels of seniority are in companies, and how important it is that we think better about how to interact with those workers and how to empower those workers. And so I do believe that the pandemic has accelerated a focus on the S and ESG. But I will note that workforce issues were important long before the pandemic. In America, 50% of workers describe themselves as disengaged, but 13%, that's 1 in 8 workers, is so disaffected by how they're treated on the job, they actively work against the interests of the companies that employ them. 1 in 8 workers in America. And so this is a big issue, both socially as well as commercially.
Thank you. And in the past year, what are some specific areas that investors have wanted to make an impact?
Yeah, so I would say that a lot of the thing that has held back impact investing up to this point has been a lack of clear measurement. And frankly, that is the thing that's held back, I think, the S and ESG. And so, if you talk to 10 different labor economists about what their definition is of a good job, you'll probably hear 10 different answers. Our belief is that until you can set a benchmark and actually really have a clear measure for what a good job is, it's really hard to show progress at a company. And so we've spent a lot of time over the past year working on a definition of what a good job actually is. We spent time with a large consulting firm trying to come up with that definition. And what we found is that, while most folks would disagree on the exact definition, most people agree that a good job is characterized by fair terms of employment, pay, benefits, how you're scheduled, et cetera. It's characterized by some form of career path where you have a future at your employer and you have the training to support that, so training and career path. And then finally, some affiliation with the mission of your company, some feeling that the firm you work for plays an important role in society in some way. And when those things are present, that activates the discretionary effort that all of us have, that extra little bit that when you get up in the morning, that extra little bit of energy that you bring to your job.
And what do you think, if there is a difficulty in measuring impact, what is the very first thing that investors should do?
Well, I think that increasingly there's this focus on measurement, which I think is a really good thing. And I know that there's talk about mandatory disclosure around workforce issues, which for public companies, which I think would be a really positive step forward. Because today, many investors, they realize that workforce issues, the quality of the workforce health, these issues matter to a corporation. In fact, humans drive every corporation, but they don't have a lot of visibility today on that issue. And so it's a little bit like, as someone told me the other day, it's a little bit like measuring the performance, measuring the quality of a car by just looking at the speedometer. If a car is moving or moving fast, you can tell that the car is working. But if you don't know what's inside the hood, if you don't know the quality of what's inside the hood, you don't know how long it's going to be working for. And so I think it's really important to have better disclosure around what's actually happening inside of a workforce at a company.
And to this point, do you think that there have been any investing frameworks or benchmarks that have been particularly helpful, or are there areas where you would like to see that?
Yeah, I think that there have been many different measurement heuristics that have been put forward that I think many of them are helpful. In particular, I really liked what the World Economic Forum put forth back in, I think it was in August, with the Big Four accounting firms. They put forward a framework for reporting on ESG issues that I think would be a big step forward. And notably, that particular framework was a practical one. It was the kind of thing that companies could do without a huge lift in terms of changing how they collected information at the companies. And so I think that there are some good standards out there. The challenge is there's too many standards, and we need to start harmonizing around fewer standards. But it's not surprising that we're in this space. It's taken us nearly 100 years to get accounting reporting to where it is today. Which I think is, by the way, a really good sort of metaphor for ESG measurement. So I think we're on a path, but I think it's going to be important in the next few years to really coalesce around a small number or a single standard.
Understood. And I'm wondering, if you are an investor, whether institutional or an individual investor, what happens when the investment strategy is not making the intended impact or falls short of the goal?
Well, it's of course true, Danielle, that anytime you set out to do something at a company, there's risk that you won't achieve it. And to me, the most important thing is not that you achieve your objective every single time you set an objective. The most important thing is that your objectives are clear and that you set in motion the right set of events to achieve them. And then to the extent you don't achieve them, it's clear why you didn't, and you're able to correct them. So I'll give you an example of what I mean by this. Our first investment in Two Sigma Impact is in a vocational training business. It's a business that's called Penn Foster. It trains about 300,000 students per year to get middle-income jobs, jobs like veterinary technician or nurse's assistant or HVAC repair, things like that. Jobs that pay $50,000, $60,000, $70,000 a year. And it's a relatively low-cost program. It's typical program costs somewhere between $750 and $1,000. And so, we're big believers that this business has the potential to change lives, and lots of lives. That being said, it doesn't always achieve it. Only about a quarter of students today actually graduate from their programs. So what we've set out to do in collaboration with management is to work on improving outcomes. But that's a long process, and it starts with better measurement. It starts with knowing where you are today, and then ultimately figuring out how to make that change.
Well, that is a great takeaway for our audience. You've shed light on how impact investing is evolving in light of the sea changes we've seen this past year. Thank you for this excellent discussion on what is a very important topic, and it was a pleasure having you, Warren. Amanda, back to you.
Thank you, Danielle, and thank you, Warren, for such an enlightening conversation around impact investing. For our final session, we want to introduce you to leaders in the ESG reporting space. Insider reporter Rebecca Ungarino welcomes leaders from the Sustainability Accounting Standards Board and the San Francisco Employees Retirement System to discuss how to make ESG reporting and data actionable. Over to you, Rebecca.
Thank you so much, Amanda. Making ESG reporting and data actionable, it's an increasingly important question that both regulators and investors are confronting today. And one of our previous guests was just talking about that. So many products are coming to market today that have a sustainability label, but the questions are how investors can actually analyze mountains of ESG data properly to make smart investing decisions. And on the other side of the coin, the way companies are actually supplying that data and whether they're doing so in an effective way. To tackle these questions, I'm thrilled to be joined by Jeff Cohen, the Director of Capital Markets Integration at the Sustainability Accounting Standards Board, and Andrew Collin, the Director of ESG Investing for the San Francisco Employees Retirement System. Andrew, to kick off with you, you've worked at this intersection for years, of course, as has Jeff. You previously helped form SASB's 77 industry-specific standards as well. For you, what is the biggest challenge you see facing investors looking to evaluate sustainability data in the most effective way today?
Thanks, Rebecca. Certainly great question, and a lot to unpack there. But I think really a lot of the starting point is, investors first need to decide, assuming that they believe, like I think overwhelming majority of investors do today, that ESG issues are material to investment outcomes. They need to then begin to unpack how and why. And I think, ESG is such a broad term, a huge umbrella under which amongst a number of issues fit. And I think the first step is really defining, which of those ESG issues are material to you as an investor, and then beginning to understand how are they material. How do they affect investment outcomes? Do they, very broadly contribute to return, potentially create or present risks? And then how do you actually weight them or integrate them into your investment strategy in a way that's consistent with your overall investment approach? And I think underlying all of that, right, is what I ultimately sort of categorize into two buckets. One is data and the other is information around ESG factors. Data, of course, is the sort of quantitative element, metrics to measure ESG performance in the E, S, and G buckets. Information would be the context and qualitative information that companies use to describe their practices around different E, S, and G factors, put that data into some context. And I think that the big challenge we're finding now, right, is that the data is not standardized, it's not comparable, and it's disclosed often in an overwhelmingly positive manner. So the story we're hearing from companies is all about their wins and not really around their challenges. And I think this makes it really hard, right, for investors to get objective data, ultimately incorporate that into their investment process. And ultimately for us as an asset allocator who's allocating money to investment managers to understand, in an authentic way where and how ESG factors truly matter.
I think there were great takeaways there, but two of the takeaways I just want to highlight there are really interesting. That difference between data and information, and what could be that lack of standardization that you point to, as well as companies disclosing some information and not others, often to put a very positive spin, I think, on what they're doing. And I think investors ought to be mindful of that. Jeff, to turn to you, of course, at SASB today, you are engaging directly with institutional investors on these topics. With the risk of greenwashing, I think this is on everyone's minds. Resting in part with how companies are actually going about reporting their data. What innovation would you like to see in how that data is actually being reported today?
Yeah, thank you for the question. And I'm really more interested in application than in innovation at this stage. I think that Warren in the previous panel pointed out that there are a lot of different resources available, such that many companies might sort of have issue with where they should take this forward. But in reality, there are a lot of really fantastic resources available that simply are not being sufficiently and broadly applied, that allows for consistency, comparability, and the data component of what Andrew was mentioning. There's certainly more than enough information, the context, the narrative, and certainly a lack of data. But just to sort of unpack this concept of greenwashing a little bit further, I think that there's really two kinds, right? There's the corporate kind, and then there's the investor kind. And when you have a corporate report that is overwhelmingly positive, filled with information that largely highlights employee volunteerism or corporate philanthropy, that's all very wonderful, but it's not decision useful to the investor, and quite frankly, doesn't have sufficient data to inform an investor to make a more reasonable decision around how ESG-related issues might play a factor into this company's operations. So being able to disclose the data in conjunction with that information paints a much more fulsome picture and allows for an accountability mechanism to achieve these net zero targets that many companies are committing to. I think that that's really important to ensure that pairing the data with the information from a corporate disclosure standpoint ultimately is where we need to get to in order to provide that right type of information from the investor perspective. Then there's this concept of investor greenwashing, which has recently seen a lot of attention from the SEC. And they, in fact, very recently issued a risk alert where they highlighted that greenwashing is something that they're going to be increasingly scrutinizing, and largely in ESG product marketing versus the compliance, composition, and reporting of those various issues. And if it's unsubstantiated, it can lead to potentially misleading claims. So one of the things that the Sustainability Accounting Standards Board is really focused on, specifically as it pertains to the SEC's requests for comments on climate-related disclosure, is to really advocate for a robust, transparent due process that will allow for market-informed and evidence-based feedback that forms the nature of standards that ultimately will lead to consistent, comparable, and decision-useful data coming from companies, and then ultimately is repurposed from an investor standpoint in their reporting. We're also very much seeking to have the SEC incorporate the core pillars of the Task Force for Climate-Related Financial Disclosure, or TCFD for short, and their recommendations, along with the use of existing and widely embraced third-party sustainability disclosures using more of a comply or explain type of approach. And then finally, sort of getting back to my theme around application versus innovation, the 2 panels ago, they certainly talked about the work that the EU is doing with their SFDR as well as the EU taxonomy, and making sure that, particularly from an SEC lens, that there is the ability to have complementary efforts with international markets, as well as just understanding how we can coalesce around and how both companies and investors communicate data is really important and a great way to combat these greenwashing issues, both on the corporate and on the investor side.
Really great breakdown. And I'm glad you brought up, how the SEC, at least in the early days, of this new administration, and under head Gary Gensler, is looking to approach the idea of ESG and try to streamline or make data more impactful for investors. It remains to be seen what we'll see there. But I did want to shift that to Andrew. While it is early days, this is expected to be a priority for the SEC chiefly and regulators. What approach would you like to see them carry out on the both data and reporting sides?
Yeah, great question. And yeah, I think it's a sea change, so to speak, since the last SEC administration on this topic. It is going to be a priority for Gary Gensler very clearly, and Jeff laid out, I think, some of the great sort of focus areas, and I think what we're hoping to see, as investors. But I think it's important to remember that there's going to be action on the Department of Enforcement side, our Division of Enforcement side, related to what Jeff alluded to in terms of both fund level disclosure as well as corporate disclosure, ensuring that there's authenticity there, not greenwashing. There's a whistleblower function set up. So I think this is sending a great signal to market participants, all market participants, that this is something that is not going to be glossed over anymore. And existing rules that are in place can be used to sort of enforce both of these areas. On the Division of Corporate Finance side, Corporation Finance side, there's a request for comment out now that Jeff was alluding to. Acting Commissioner Allison Heron-Lee issued that. It's going to be followed through, really with a focus on climate risk. And I think this is a huge priority for us as a pension system. We announced our ambition to be a net zero asset owner by 2050. Last March, in alignment with the objectives of the Paris Agreement. Our ability to do that, to allocate capital in a way that's consistent with the transition to a low carbon economy, ultimately, begins with the disclosure from the companies in which we invest, and them doing so in a way that gives us a fulsome picture of the risks and opportunities related to climate change. And so the reference to the Task Force on Climate-Related Financial Disclosure, incorporation of SASB standards, will be essential there for us to achieve that objective and to protect our beneficiaries as fiduciaries from risks, financial risks related to climate change. And then lastly, it's great to see that there's coordination amongst the different departments at the SEC. Really spearheaded by Satyam Khanna, who's sort of the climate czar, so to speak, and ESG czar at the SEC. So yeah, a ton of focus and regulatory focus beyond just the SEC directly. The House Financial Services Committee has seen a lot of ESG related issues on the agenda there, diversity, inclusion, corporate board diversity, ESG disclosure have been priorities there for Chairman Waters. The DOL, I think, has decided to roll back some of the Trump era rules around ESG. So a lot of tailwinds from the regulatory front for ESG related issues.
And Andrew, I'm glad you brought up the board diversity bill as just one of the issues we're seeing the House Financial Services Committee tackle. I wanted to turn it to Jeff to talk about the issue of human capital data. Of course, this is such an important part under the whole ESG umbrella. I want, it's of course an area where SASB has done a lot of work and analysis. When it comes to human capital, Jeff, what do you believe is most actionable for investors to see and the data that they and the reporting mechanisms that they can use most effectively?
Yeah, absolutely. And this is where I think that Warren put it well, that in the past, human capital issues and social issues have maybe been less actively considered in the investment community. And a lot of reasons has been because there's been maybe a lack of quantitative evidence, but that's changing very rapidly. And we would encourage the SEC and others to obviously focusing on climate, very important existential issue for all of us. But ultimately, when thinking about financially material ESG issues on an industry-specific basis, many companies within many different industries are heavily driven by human capital related issues. And in fact, as a thematic issue, it's the human capital is the second most prevalent issue in the SASB standards. The standards encompass 77 industries. There are on average 5 to 6 material issues per industry with 1 to 3 metrics that help to measure or create data on those material issues. And thinking about what are some of the issues that sit underneath human capital, that's employee diversity, as you alluded to, Rebecca. That's inclusion, it's engagement, employee health and safety, and labor practices. And some of the areas that SASB is very deeply looking at as part of our most sort of broad-ranging research and standard setting project that will ultimately in the future potentially lead to the evolution of the standards is worker well-being. So thinking about mental health, physical well-being, and other health-related benefits, particularly relevant as we're all, for the most part, working from home and the isolation that comes along with that and the sort of psychological effects that might have. Thinking about investments in the workforce, career building opportunities, which was alluded to in a previous panel, skills and development, as well as the appropriate sort of living wages and retirement savings opportunities. Culture, which is sometimes more difficult to measure, but thinking about inclusivity and engagement is something that is ultimately very important to ensure that diversity is successful within the workplace. And then finally, the alternative workforce and thinking about contingent or contracted labor, or as many call it, the gig economy. So these are some of the various issues that we are assessing and evaluating as part of our market-informed process across all 77 of the industries that SASB covers in its standards. For anyone that has useful context or would like to support the standard setting process, all of our board meetings are held in the public domain. We accept public comments on these various issues to really ensure that what is defined ultimately is reflective of what the market is seeking and what is financially material.
Absolutely. I would love to leave this discussion off with a word of advice, really, to any audience members who are watching, who maybe are really new to this world. I think we've talked about we've got really in the weeds with this area. And if there are any audience members who are just approaching, sustainable investing, they aren't sure where to start, I'd love to hear from both of you on this. Andrew, what would you say to an investor who is just maybe approaching sustainable investing? They aren't really sure how to make sense of all the information out there. What would you tell them?
Yeah, it's something we even though we're further along in this journey have to do every day. And I think that the starting point really is beginning with a definition of which environmental, social, and governance factors matter to you as an investor, and then ultimately trying to understand why do they matter, what's your objective for seeking an investment outcome that incorporates them. And is this to achieve alpha? Is it to reduce risk or volatility, other measures of risk? Maybe it's to create a positive impact with your capital on social or environmental issues you care about. Maybe it's simply to avoid investments that you have a moral objection to, as socially responsible investors have been doing for a long time. So I think define those issues, understand how and why they matter for you. And then ultimately, it's about finding investment solutions that have a lot of authenticity around how they're incorporating and thinking about ESG factors. And this is, I think, best understood through dialogue with whoever is providing those investment solutions to you. You want to see that they have conviction in their approach to ESG, that it's genuine, that they're being transparent and thoughtful about it. And I think a great question to ask is, how along your ESG journey has the consideration of ESG issues changed the way that you invest? And I think that's really, one of the things we ask managers all the time is, how has this made you a better investor? How has this changed your process? We don't want to hear that, this is something we've always been doing or it's always been important. Something we hear a lot. but it's really about what is that intentionality, how have you leaned into this issue, and how is it going to ultimately give us a better investment outcome, again, whatever our objective is ultimately.
So asking investors, what matters to them, and going back to the heart of what they would like to, achieve. Jeff, what would you say to an investor who is just approaching really sustainable investing and isn't sure where to start?
Yeah, and I just really want to highlight Andrew's final point. Those that have been around for a while but have been recently repurposing their marketing documents to say that they've been doing or integrating ESG factors since their formation, it's a dubious claim. So one that I really wanted to underscore. But I would say that for someone that's just getting into the space, whether they are an asset manager that's looking to understand it more deeply and how it can be helpful and relevant to their process, or a retail investor, is just forget all the labels. There are lots of different definitions for what impact means, what ESG means. And as Andrew keenly noted, there is really a spectrum, and you can approach this a number of different ways. And it can be very easy to get confused or overwhelmed by deferring definitions or approaches, but ultimately it's about what you are looking to accomplish, and that there are lots of different resources that are available to help guide institutions, individuals, as well as asset managers who are seeking to leverage ESG-related information to inform their investment process or their decision-making, or potentially reflect their values if it's an impact-focused individual investor or organization. Just to name a few for those that are interested in learning more, SASB, we have a lot of great resources for institutional asset owners as well as investment managers. The IIRC, the UNPRI series, they all have fantastic resources, both for individuals, asset managers, companies, asset owners. So ultimately, don't be intimidated by the acronyms. Don't be confused too much by the definitions. Ultimately, just set that objective Andrew mentioned, find some of the resources that most fit the objective you're looking to achieve, and then begin incorporating that into your decision making.
I think that's a great place to leave our discussion. And I think one of the things that you highlighted that I think is so important, as you both brought up, was thinking more deeply about labels and going a little bit beyond, okay, what's under the hood, which I think is so important for investors, at any stage of their, ESG journey, as you put it, Andrew. So thank you so much, Jeff and Andrew. Really appreciated the discussion today. Jeff Cohen, of course, of the Sustainability Accounting Standards Board, and Andrew Collins of the San Francisco Employees Retirement System. Really appreciate your time today. And now I'll send it back over to Amanda.
Thank you.
Thank you.
Thank you, Rebecca, Jeff, and Andrew. And thank you again to all of our speakers for these interesting and important conversations around financing net zero. And thank you to our sponsor, IDA Ireland. Also, a big thank you to you, our audience, for tuning in. I hope you were inspired by the conversations here today. We will make the recording of today's live event available on our social channels. Remember to share on social media using the event hashtag #FinancingNetZero. And in a few moments, our survey will pop up on the bottom of your screen. We'd love to hear your feedback. Again, thank you all for joining. Goodbye.